If you are a Canadian business owner, you can be leaving thousands of dollars on the table every single year without even realizing it. CRA gives you two ways to tax the dividends that you take from your corporation. And every year, I see so many entrepreneurs choosing the wrong one, which is costing you thousands of dollars in taxes. And this is one of the costliest mistakes I see entrepreneurs making. Now imagine you're standing in front of two doors, and behind each door is your hard-earned profit. But the difference between the two doors is that one door will take a lot more taxes from you when you file your personal income tax. In this video, I'm going to show you the strategy that the pros use when deciding which door to open. And the choice is between an eligible and a non-eligible dividend. And choosing the right type of dividend can put thousands of dollars back into your pocket where it belongs. Hi guys, I'm Manu and welcome to another episode of Sweet Money. I'm a Canadian and US CPA. I've got a cool little accounting firm better known as Chandler CPA. As a tax professional, I have guided many Canadian entrepreneurs through this exact issue. And I want to pull back the curtains and show you how you can use these tools effectively, which at times can appear very confusing. So let's get into it. Before we get to the trick, you first have to understand the game that we're playing. The Canadian tax system is built on a principle called tax integration. Think of it like a relay race, all right? The government wants the total time of the race to be roughly the same no matter what direction you decide to run. Your corporation runs the first leg, and you as an individual, you run the second leg. Now, if your corporation runs a really fast leg by paying less taxes, in the second leg, the government will make you run a slower leg by penalizing you and making you pay more individual taxes. And in their eyes, the CRA eyes, they have now evened things out. The goal is fairness, but the system isn't perfect. And in these imperfections, we find little nooks and crannies that helps us identify opportunities in which you can save taxes. Now let's go back to our two-door analogy. Now think of your after-tax profits sitting in two buckets. Bucket number one is filled with profits that were taxed at the small business tax rate. This is the income your company earned on the first $500,000. Because the corporation got a big tax break on this bucket of money, it's kind of like a bucket that's called easy in, but there's a catch. When you go to take this money out for yourself, the government makes you use a leaky pail, and this leaky pail is what we call taxes. Bucket number two is filled with profits that were taxed at a much higher general corporate tax rate. This is the income that you earned that was north or above $500,000. Now, since you had a hard time filling up this bucket because you're taxed at a higher rate, the government will then give you a deal and tax you at a lower rate when you fill out your individual tax return. So just to quickly summarize, when you pay less corporate taxes for your small business tax deduction on your first $500,000, you will end up paying more taxes on the individual tax return to help balance things out. And on the flip side, when you earn north of $500,000, that amount will be taxed at a higher tax rate, which means at the individual tax return, you will be charged a lower tax rate. And this helps even things out. But the entire strategy hinges on knowing from which bucket you take your dividends in order to take advantage of the imperfections in the tax system. All right, now let's put some official names on these two buckets. Every dividend your Canadian-controlled private corporation pays out must be either an eligible or a non-eligible dividend. Let's first talk about the leaky pill, the non-eligible dividend. Non-eligible dividends are the dividends that are paid from the leaky bucket, the bucket from which the corporate taxes were at a lower rate. So the logic is the corporation got a really good tax rate at the business level, therefore we will offset that benefit at the individual level. Therefore, when you file the individual tax return, the rebate that you are given on your dividend income is much lower. And the way the calculation works, excluding all provincial taxes, because each province has its own tax rate. At the federal level, what happens is the non-eligible dividend is grossed up 15%. So you have a $100 dividend, it's grossed up 15%, which means you're now taxed at $115. Then you get a small tax credit of only 9%. It's 9.03%, but just to round it, it's 9%. And this helps reduce the taxes that you owe. So what does this mean? That you get a low tax credit, which translates to a higher tax bill. Now, let's look at the second door, which has the pail that isn't leaking as much, which is called the eligible dividend. This income was hit with a higher tax rate at the corporate level, and this bucket has a very special name. It's called the General Rate Income Pool, also known as GRIP. Disclaimer: if your corporation has a GRIP balance, it can then pay these tax advantage eligible dividends. And this is where the analogy gets interesting. Now, because the corporation paid so much tax up front, the government gives you a massive personal income tax rebate. Now, coming back to the $100 dividend example, if your eligible dividend is $100, you are now grossed up at a higher rate of 38%, which means you will now get taxed on $138. However, the tax credit is much higher at 15%. And this bigger tax credit of 15% results in a smaller tax bill in comparison to the 9% tax credit. But here's the kicker. Your corporation just can't willy-nilly pick any type of dividend that it wants. You can only choose the eligible dividend if you have the money sitting in your GRIP account, the General Rate Income Pool. And in addition, when you pay those dividends, you have to formally designate it as eligible dividends for tax reasons. Okay, guys, look, while you're at it, give me some SLC. SLC stands for subscribe, like, and comment. Now, this is vital information that can help a lot of entrepreneurs out there who are paying more taxes than they have to. Smashing that subscribe button won't cost you anything, but it can help someone save tons of cash. So please help your fellow entrepreneurs and fellow Canadians by doing the right thing. Okay, now we're going to put all this information into a real world example and show you exactly how much taxes we can save. Now, this is the aha moment where with real numbers, we show you the exact savings that you can put back into your pocket. So without further ado, let's meet Sarah. Now, Sarah owns a very successful CCPC in Ontario, and she had a fantastic year in which her corporation had profits of $600,000. As mentioned earlier, the first $500,000 of her profits were taxed at a lower rate, the small business tax rate, and then the incremental $100,000 was taxed at a higher rate, I guess known as the normal business tax rate. This now translates into her corporation having a GRIP balance, general rate income pool balance, of $100,000. Sarah wants to reward herself and pay herself a dividend of $50,000. Now, Sarah's feeling good. She made her salary, she made her RSP contributions. Life is great. She made her CPP contributions. Her retirement is set for. She wants to reward herself. She's worked hard. She's earned all this profit. She's like, you know what? Let me take care of myself. I'm going to pay myself dividends in the amount of $50,000. All good, right? Let's keep going. The default path, the way the system has been set up, is that you will automatically pay yourself non-eligible dividends. So she does what most entrepreneurs out there are doing. She pays herself $50,000 in dividends, which are classified as non-eligible dividends. Now, clearly, Sarah's accountant is not thinking strategically. Dividends paid, $50,000. Gross up, 15%, which equals $7,500. The taxable income Sarah reports is $57,500. Because Sarah lives in Ontario and she decides to apply the rebate of 9%, her tax bill will be roughly $12,000. Sarah has a light bulb go off in her head. She wants to get a second opinion, so she comes to see me. Now let's rewind. Sarah's new good-looking, dashing, charming tax strategist advises her not to claim non-eligible dividends, but to take the dividends from her GRIP balance, which are also known as eligible dividends. And this is how the numbers roll. Dividend, $50,000. Gross up of 38%, which is $19,000. She is now taxed on $69,000. Now you're probably thinking, she's getting taxed on $69,000. Holy moly, that makes no sense. Her tax bill will be much, much higher. This is a terrible deal. This sweet money guy has no idea what he's talking about. But my friend, you're looking at the price before the tax rebate has been applied. And that is the most important part of this whole puzzle. You see, Sarah now gets to use a much more powerful eligible dividend tax credit, what I call the huge discount. So we run through the numbers, and after applying this huge credit of 15%, her tax bill, federal and provincial, because she lives in Ontario, comes out to $7,500 for the year. By choosing the right bucket and getting the larger tax credit, Sarah put $4,500 back into her pocket right where it belongs. Furthermore, imagine Sarah starts saving that $4,500 in S&P 500, the TSX, and some ETF. That money will compound and grow to tens of thousands, hundreds of thousands, and in some cases, depending on the longevity of these investments, it can also be millions of dollars. Now, this isn't some shady loophole, okay? It's in the Tax Act and the CRA recognizes it. The trick is just knowing the rules of the game. Now, of course, this is level 1. As you move to level 2, this game gets a little more complicated. The strategies get more complicated. For instance, paying out certain dividends can trigger what we call an RDTOH, a refundable dividend tax on hand. And think of this as getting a security deposit check back, okay? It sends money back to the corporation that it previously overpaid on investment income. And we haven't even touched the holy grail, the completely tax-free capital dividend account, the CDA. Think of the CDA as a VIP pass to an extravagant event, okay? This money, the system allows the money to bypass the entire tax system without you having to pay a single penny in taxes. Now, this is a powerful tool for another video, okay? So therefore, make sure you subscribe so you don't miss out on it. Now remember, the tax rates and the credits vary by province to province. And the strategy that worked for Sarah in this example may not work for you. Therefore, it is very important to sit down and strategize and come up with a game that is in your favor. So what did we learn today? Stop paying yourself dividends on autopilot. Before you make any payment to yourself, sit down and ask yourself, from which bucket is this money coming from? Is this dividend income coming from the leaky pail, or is it coming from the pail that is sturdy and is not leaking? And look, making the right choice only puts money back where it belongs, in your pocket. It burns me inside when I see people paying more taxes than they have to because they're not getting the right advice and they're not strategizing the way they should. And if you have any questions, in the description, you'll find my contact information. Please reach out without any hesitation, because remember, it all starts with a simple conversation.